Hey everyone, thank you for joining the webinar. I am just going to give one more minute just to let everybody else join. If you have trouble hearing me, you can just put it in the chat box, or if you're not able to see the screen or my screen, just please let me know, and I will see if I can make some adjustments. Okay, so thank you all again for joining the webinar. I'll jump right into everything. What I am calling this webinar today is the impact of rising interest rates. Essentially just a review of the first quarter of 2023, what we've seen in the GTA commercial real estate market in terms of the activities, with a specific focus on retail and industrial properties. So give you an idea, just an overview of what we'll cover today. First off, we'll just briefly touch on the retail market, the sales that we've seen in the first 3 months of the year, and how that is compared to what we saw last year and in the past. The next segment we'll cover on is the industrial market and the activity that we've also been seeing there, and how that has changed really over the first 3 months. And then ultimately put it all together to provide, hey, where are we in the cycle today? Where do you think we're in the cycle today? And how all this information is most relevant to you and your business, and how you can, maximize some of the investment opportunities going forward. Okay, so what I'm calling this is really the transaction collapse. So on this first chart here, what you'll see is retail properties in the GTA over 10,000 square feet that have sold in comparison to the previous last 5 quarters. And what we saw in Q1 of this year is roughly about 14% drop in sales volume from last year. Now that's a total of $418 million worth of sales that we saw occur this year. And that's down from 488 million we saw last quarter, or in quarter of 2022, Q1 of 2022. Now this is still roughly double the amount of sales volume we saw in 2019 as we can compare it here. So even though it is a down year, it is the value, or the total volume of sales, is still high in comparison to the last 5 years. What is interesting about it, and I will go over to the next chart here, which describes the number of transactions. So the number of transactions actually has dropped off 50% from the peak of last year. We saw a total of only 11 transactions this past quarter. That's down from 25 in 2022. And realistically, if we take a look at the past 5 years, we see that this is actually the lowest that we've seen over the past 5 years. Even in 2020, even during the pandemic, we saw even 15 more sale transactions that occurred. So we're in an interesting space. And what I'm taking a lot from this data is that even though we're seeing less number of transactions, the values are actually relatively staying the same or higher than what they were previously, which sheds light to me that values aren't decreasing overall, and that we're just seeing a slowdown in the effective activities. Now, obviously the main culprit that we attributed to is the interest rates. Anytime you have 8 rate hikes in a row over really a 13 or 14 month period is going to affect the market, and we are drastically seeing that. What I'm finding anecdotally from a lot of clients is that many potential sellers and even potential buyers are sitting on the sidelines waiting to weather the storm to see kind of how things pan out, and hence why we're seeing such low transactions. But what's interesting again is that the values are still remaining the same, even with the low volume of deals. If we take a look at the next chart, this will illustrate it a little bit better and give us a better idea. So what this chart here shows is the last 18 months of transactions, all the way from January 2022 to March of 2023. And we see on a month-over-month basis how the volume of transactions have occurred. So if we follow the trend line, and what we're seeing here is that really over the last 18 months, we're starting to see a decline in the amount of transactions. If we take a look at March, which looking back now, we can say was the peak of the market, we had a high of 12 transactions in this year, or in this month. And the reason why also it's the peak, because this is when the Bank of Canada started hiking interest rates, and then we can continuously see the decline of sales over the next 12 months. If we take a look at the month of August, which I find interesting, is that commercial real estate is a lagging indicator. So it takes on average roughly about 4 to 6 months for a deal from once it's been accepted to actually completed for us to log a sale. So a lot of the transactions that we see in March were originated or started in 2021. If we look back at August here, there was no transaction in the month of August in 2022. And that roughly makes sense with about 4 to 6 months from the first rate hike, which in March, which makes sense because as soon as the rate hike started to go up, buyers pulled back and we saw a log of 0 transactions. And then we can follow the coming months throughout to end the 2022 and into 2023, we saw a decline completely in the amount of sale transactions overall. So that kind of gives you an idea. Roughly, there was only 4 transactions that occurred in the month of March alone in this 2023. So we really saw, a big effect, specifically on retail. If we take a look at the industrial market, now the industrial market has been probably one of the best performing asset classes really over the last 5 to 8 years, just with the over demand of warehousing, as well as what we call the Amazon effect and entire supply chains. The GTA market has remained extremely strong for industrial products specifically. And what we've noted, it really outpaced all other asset classes. Even with that being said, we saw a 44% drop in the amount of sales volume in Q1 of this year. So that's down. So we saw about $471 million worth of transactions in this first quarter. That's down from $843 million we saw in 2022. So a significant drop. Granted, this is the peak of the market. This is probably the highest that we've seen ever in one quarter of last year. So it's difficult to compare. It's not necessarily fair to compare, but gives you a roughly idea about 54% of down. And this is still interesting enough. Sales volume is still higher than 2019 and 2020. So overall, we're still doing quite well, even though it has dropped significantly. And this is translated really right over into the number of transactions as well. So we saw roughly about 39 transactions occur in the first quarter of this year. That's down from 84 from last year. So again, similar to retail, what we're finding is that the values are still remaining relatively the same or increasing, even though we're seeing significantly an amount of decrease in the number of transactions. So this bodes for sellers or building owners that your values are still maintaining themselves overall. And really, this has been dictated by the lack of supply of opportunities available for sale and buyers being forced to make decisions and purchase product based on the limited amount of choices that they do have. One interesting note is that, again, this is the lowest number of transaction volumes we saw in the last 5 years. So even the pandemic was more than the first quarter of this year. So gives you somewhat of an idea. If we take a look on a month over month chart, we can see the similar types of trend lines that we saw with retail. So again, the effect of interest rates, we take a look at March here, and then going forward, we started to see a decline. Of course, there's some peaks of some months where there's larger amounts of transactions. A lot of this I attribute to deals that were done towards the end of 2021 that are now rolling over into 2022. And the peak in March, again, we saw about 43 transactions in comparison to March of this year with only 13. So what does this essentially all mean for you is that for both retail and industrial, what I can say is that pricing hasn't dropped. What we're finding is proper product, and this is specific to the GTA, product outside the GTA, we're starting to see some increases in cap rates, as well as some compressions in some of the values, depending on the locations and where they are. But overall, if you're in a GTA, if your assets are in a GTA market, they perform quite well, even through this rough patch period. What I can say is the biggest reason for these strong valuations in my eyes, and from talking with a lot of clients, is that the main fact is that many owners are actually quite well capitalized. They don't have large amounts of debt. they've owned the properties for a significant period of time, and a lot of the circumstances, even specifically with retail and industrial, they're getting top of the market rents and buildings are full. So there's not much vacancy and there's not much pressure on vendors to sell their properties at a significant discount, barring that they're able to carry the properties even through a high interest rate environment. So this has essentially put a constraint on the supply of opportunities available, and that's left the current buyers with a shortage of opportunities that they can actually choose from in order to purchase. And ultimately, a lot of the vendors I speak with or we work with is that, look, they are telling me that, hey, if I don't get my number, Cole, it's okay. We have time. We can wait until the market comes back, and we can get those numbers if buyers are having issues. What we're also finding with a lot of buyers too is that financing has affected a lot of the transactions. But what they are forced to do is come up with higher capital or equity requirements, which we are finding that they're able to do. And buyers are a lot more disciplined with their underwriting and their analysis of particular deals. So we're not seeing them overpay for property, but they're being more picky and choosy between the assets and the underlying values of what they're deciding to buy, and which ones make the most sense. Ultimately, right now, there's many buyers are operating quite opportunistically on specific deals. Private capital or private investors are the ones that are really dictating the market right now. Institutional buyers haven't been overly as active, and this is really can be exemplified or been shown through product selling over 15-20 million, where we saw a great reduction in the amount of transactions there compared to deals that are done below 10 and even below $5 million. And the reason being is anytime you get over the $15-20 million mark, financing is going to play a key part in whether that transaction goes through. And just the way the interest rates are and the cap rates and the numbers, it's making those deals and those opportunities difficult to pencil out. And as a result, those are taking a little bit longer to sell. Where if we look at smaller transactions, sub 5 million or even sub 10 million, many buyers either A, have cash or large cash positions, equity that they can put as down payments to satisfy their lenders' requirements. So that's what we're kind of what we're finding is happening in the market. So the ultimate question that I pose to you is, where do you believe we're in the cycle? Now, this is a chart of an investor emotions through the natural business and real estate cycle. If you start at the end here, we can see optimism as we go to euphoria through the peak, and then it declines through fear, desperation, and into a depression, and then we bounce back up into optimism, and it kind of flows in this ebbs and flows chart. So my question to you is, where do you think we are today in today's market? Are we closer to the top? Maybe we're closer to the bottom, we've seen the worst of it, or we're somewhere in the middle. My feeling and my opinion is actually we're right here in the fear stage. I think that we are closer to the end of this cycle than we are at the beginning, and we still have some ways to go. And there could be some factors that can push us in either direction that we're anticipating waiting on. Obviously, the Canadian economy has performed quite well, but the big question is how we are going to avoid a recession. And unfortunately, we operate in a global market. So even though we may be performing well, our neighbors to the south, the US, they're teetering on potentials of recession, as well as the overall global economy, Europe, Asia. They're all running through these challenges. And I think even if one of them goes into a recession, it could push the whole global economy into a lower place. And, we're going to have to we would be ultimately bystander and affected by that. But I do think we're still in this fear stage. I think we still have a little bit more to go. I anticipate us probably bottoming out by the end of the year. And then again, that really depends if we hit into a recession, and then how and deep and effective and long that will last will really determine and how quick we get out of this lull at the bottom here, and how fast we can get back up into better times. So what this leads to is a question: if we are anticipating a potential recession, or there may be fears that we may go into this, the question I ask is your property or portfolio ready for a recession? What I've created here and I put together is an assessment. What it is that it takes a look, it takes 5 brief questions that will give you some insight into whether you are prepared, or your properties or your portfolio is prepared for an incoming recession, and do you have the natural resources to weather the storm going forward. How it works is, what I've created is the assessment tool. So you would head over to colebraithwaite.com/assessment. You would take the quick 5-question questionnaire. These questions will then generate results, which will be sent to myself and my team. What we'll do is we'll put together the results and provide it back to you in an email format with an understanding of where you are in the market, so that you have all the information. And then from this, we can then have a better discussion on how to position yourself for the future. You may take this quiz and the questionnaire and get it and take from it that, hey, you are well positioned, your equity is great, tenants positions are good, your vacancies are filled, you're in a great place to withstand any shock that may come in the market. Or you may realize from this that, hey, no, I need to do some things now that I need to improve on to improve. For many of my clients that actually have taken it right already, they found that it's kind of shed some light and given them some context to the options that they have available to them, so that they can make better choices in today's market. Because we don't know where things are going to go, it's always best to be prepared and to make some adjustments. So this is a resource that I created that will help a lot of my clients and owners get some ideas as to whether it is. So head over to colebraithwaite.com/assessment, take the test, and we'll get back to you with a full report on it, and see how we can help you through going forward. So just want to thank everyone for the presentation. This was just ultimately just a brief analysis of what we saw in the third quarter, or the first 3 quarters of this year. What I'll be doing is hosting these webinars quarterly. So the next ones we should anticipate in August, and then another one in October. So look out for those dates through email. And ultimately, I kept the information quite general as it relates to everyone in the GTA, but we all know that each property and each portfolio is going to have its specific requirements. Each owners are going to have their specific needs. And I encourage you to reach out to me and give me a call so we can discuss your current situation and really how we can help better position you for the coming future. Many of the clients that we've worked with just recently have asked us really to start doing a lot of valuations and what they call mark to market their positions. Essentially, they're looking at, Cole, where's the value of my asset in today's market? With these interest rates changing, with the amount of supply available, where's the value? Has it changed? Has it not? Will it improve? Do I anticipate it going down? What should I do with tenants on renewals? These are some of the questions that we work with owners to discuss to help them make better decisions so that they can achieve a lot of their financial goals going forward. So if this is something that you'd like me to do for you, reach out to me or give me a call or send me a quick email note on it, and we can schedule a time to discuss more. So until next time, I look forward to keeping in touch with you all, and appreciate you. If there's any questions that you have, you can also send me a quick email. My contact information is here, and look forward to being in touch. Thanks.